You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Well, Eric Hadik is with us now. You find him at INSIIDE That's INSIIDE tracktrading.com. Eric, it's great to have you back. You know, earlier today I was thinking about something. I was looking at markets, and I remember you saying this over 2 years ago, or nearly 2 years ago, that basically the dollar does better when there are Democrats in the White House than Republicans. And I kind of tucked it away in the back of my mind, not really thinking much about it. But here we are 2 years later. Ostensibly, we have a Democrat in the White House, although, you know, we all have our own opinions about who's really running the country. But the fact of the matter is the dollar is trading at decade highs, multi-decade highs. And that was a call you made quite a while ago, and it came true.
Well, I think, I don't even necessarily know what the strong connection is, although I have in some of my articles that I did back in the mid-2010s, I've kind of traced a couple of the key ones. One of them is that the kind of governing Republican philosophy is that a lower dollar is better because it increases exports, and that Democrats have other reasons why a stronger dollar is better. And again, that's not even to make any judgments. It's just observing what has been the case for 30, 40 years. And it's funny because I think that when it really was the most glaring was during the Reagan administration, when you had a strong dollar kind of hurting some of the American economy and exports activity. And you hit a point. It was after the big G whichever meeting. I forget whether it was G5 at the time and
G7 or G20.
Yeah, it was in February of I think 85, and they had kind of all agreed that the dollar needed to come down, but you couldn't turn on a talk show on television. Of course, we didn't have the internet and other things back then, but news coverage, press releases, without seeing, at the time it was James Baker, who was, I guess he was Secretary of the Treasury at the time, but talking down the dollar every opportunity he had. And anytime it started to bounce, right away there was something released, something issued to kind of undercut the dollar, because they really wanted a weaker dollar and thought that would really help spur economic activity and exports. And again, it's not a judgment call, it's just an observation. And if you trace the dollar's activity since that time, you can see that on balance, it's had its upswings during when there's a Democrat in the White House, and its downswings during whenever there's a Republican in the White House. And actually, I think I had this conversation with you. I know I did with a few other podcasts and broadcasts that I do. I was bringing this topic up in the middle of 2015 to the middle of 2016, and saying that all my work was showing we should see a significant top in the dollar in late 2016, early 2017. And that led me to believe a Republican was going to be in the White House. And this was before Trump even became the candidate. And I kind of kept repeating that. And then once Trump became the candidate and everything kept looking like Hillary Clinton was still going to edge him out, I kept discussing this dollar connection. And sure enough, the Republican gets elected, the dollar topped in January of 2017 and headed down for 2 years. And then it kind of rebounded back and then headed down again. And it was looking like a major bottom would be in store in early 2021 by my cycle work and my technical work. And so once again, in 2020, I was saying same connection, but the opposite result, that I thought a Democrat would be in the White House because of or linked to. It's not that one cause, and obviously I have to be correct in my dollar analysis for the government or the political correlation to be accurate. But it was all showing to me that the dollar needed to bottom out in early 2021, enter a new bull market, and I was projecting it getting to its highest levels since back in 2001, 2002, when it had another major peak, just as a Republican was in office and going to be in office for 8 years then. And so there is a strong correlation, and that was certainly one of the factors. I was more focused on my analysis of the dollar and what that meant moving forward in the markets, but the political ramifications were one of the things that I've seen be such an uncanny accurate correlation for going on 40 years that I can't ignore it. So yes, that was certainly one of those things. I don't know if my current analysis for the dollar to peak in here for a few months. I still think there's another high out in early next year. I don't know if that has any real implications for midterm elections. I really haven't seen it be that specific. It's a much broader thing, so I wouldn't try to extrapolate too much out of that. But I think we are in for a corrective period in the dollar for a couple months here.
Interesting. Yeah, well, you notice the difference of the news cycle. Nobody's complaining about the American exports being negatively impacted by the higher dollar. I guess it's leading to maybe, I don't want to call it less expensive, but not as much inflation on the products that the country's importing. So nobody's really mentioning anything about it. But as long as we're talking about inflation, what is your take on it here? What do you think we're going to see according to cycles?
Well, from a commodity price inflation, and that's really what I'm assessing more than, even though the CPI and PPI ultimately are closely connected to that. I'm watching commodity price inflation, things like the Goldman Sachs Commodity Index, things like the price of grains and oil and even metals, other key commodities. My work has been showing and continues to show cycles had a major bottom in the first quarter of 2020, and I think they're going to have a pretty significant top, at least a 3 to 6 months, 6 to 12 month possibly peak in the September-October 2022 timeframe. So out right on the cusp of third and fourth quarter of this year. So I think there still is the potential for some additional upside. That doesn't in and of itself mean that we're just continuing up from here. In theory, you could set a peak here and sell off and consolidate for 3-4 months and then just briefly spike to a new high in September, October, and it would fulfill that cycle. So just because you're anticipating a cycle high doesn't mean it's one long uninterrupted uptrend leading into that. Just as expectations for a cycle low don't mean that you're anticipating a complete and uninterrupted downtrend leading into those lows. But all that to say is, I think that's when we're going to see our peak in commodity price inflation. Wouldn't surprise me if your other inflation indicators closely coincide with that. But I also, based on some intermediate analysis, am looking for some of these markets to, like oil is a perfect example, to peak in the middle part of June, since we saw the run up into early March that perfectly fulfilled this very consistent 14 to 15 week cycle in the energy markets. Since that time, I've been focused on this middle half of June to be the next peak. And kind of like I was just describing with cycle highs and the trend in between them, that included a decent sell-off and then kind of a consolidation period in March, April, and then a new uptrend starting to take hold in late April and through May, which we're seeing continue move to the upside. And I think that energy markets should peak in the next 1 to 2 weeks based on this intermediate cycle, and that you could see some other commodity price factors peak around the same time. So I could certainly see an intermediate peak coming in here in the next 1 to 2 weeks, get some corrections, some selling off from there, and then some other factors or more of the same factors coming back to life in a month or two and driving a potentially final rally into September, October.
All right. So does that mean that commodity prices will come down or that the inflation rate will be peaking?
Well, like I said, I'm discussing, when I'm talking about energy markets, I think that they will set a peak here in probably the next even week to 10 days. And so, yes, from whatever that peak is, I would expect those prices to come down. Now, we could still have significant upside before hitting those peaks. So there's no telling right now from purely a cyclical standpoint whether a month from now will be lower than where we are now, or if there was a strong enough spike up going into that cycle high, we might just be coming back down to where we are right now. That type of price analysis has its own indicators and variables that factor into that, which will be a little clearer once we've seen the peak start to take hold. But I do think that the rate of inflation will probably start to slow, even if we're heading to higher highs out in that September, October timeframe. And that's where you get into perception, which is what really drives the markets more than the actual event or the actual numbers, the actual fundamental. It's the perception of those. And I think that will have its own impact on some of the markets that are closely related to interest rates and inflation, like the stock market and like metals.
Right. So inflation peaking, but probably not going away, and perhaps peaked commodities prices, but they still could potentially be very, very high.
At least until we get past that September, October timeframe.
Mm-hmm. So how does that figure in the outlook for precious metals?
Don't just survive, thrive. The Financial Survival Network.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Precious metals, I think, are entering what should be their most advantageous period. And the reason for that, in addition to the technicals and cycles that I follow, I think this is where you could get two often competing factors working in their favor. And we've just discussed both of them. One is the inflation and even interest rate factor, which is kind of a paradox where gold and silver are concerned. You get your inflation, commodity inflation, which is typically seen as a supporting factor for gold and silver, but in many of those cases, and this one is another prime example, you then get the reaction of interest rates and higher interest rates and this perception that the Fed is just going to keep raising them at this dramatic pace. And that's one of the most negative factors for gold and silver. So they've had trouble really building any momentum. But I do think that based on all of my expectations combined, that you're nearing a window of opportunity where you'll still have the inflation intact, like we were just saying, and that inflation will still be there, in my opinion, through September, October, and then it'll still be there after that, but on the other side of a peak, in my expectations. So you've still got the inflation there, which is a support for gold and silver, but you may come into the phase here in the coming weeks where the perception regarding interest rates starts to diminish a little bit. And it's kind of like we were saying about the inflation rate. Well, maybe the rate of expectations where interest rates are concerned, that if on a scale of 1 to 10, 10 being the most extreme, we've had higher interest rate expectations be a 10 for the last couple months, and that has just been this big weight on gold and silver. Well, maybe in the coming weeks, or getting out even into July, that expectation, maybe all it does is moderate a little bit down to a 9 or an 8. Where there still is the expectation for higher rates, but the extremity of it is starts to minimize a little bit or moderate a little bit. And that's the type of thing where you can suddenly open up this window of opportunity where now gold and silver have the inflation still supporting them and other factors. You still have the safe haven, you still have everything going on in Europe, Ukraine, in Russia. You still have other factors. You have North Korea certainly consistently flexing their muscles, and the U.S. not really knowing where China stands with regard to Russia, Ukraine, with regard to North Korea. And so you've got all these uncertainties there. So the safe haven status is still underpinning gold and silver, and you've got inflation still underpinning them. But they've had this big ceiling, this big weight of higher interest rate expectations, keeping them under pressure. And if you start to remove some of that pressure, now you've still got all these supporting factors pushing up on them, and you've got the deterring, restraining, resistance factor starting to let up a little bit. That's the type of opportunity where you see gold and silver often have their quick, sharp moves. And the way some of my indicators are lining up, gold and silver starting to hone the time frame when I think an accelerated move up is becoming far more likely.
All right. So interesting. And so interest rates are intimately tied in with the price of gold, obviously. So we could be seeing an end to interest rate increases faster than we thought possible, huh?
Not even necessarily the end to them sooner than, but again, this is how the markets just move on perception. And I think that's where many traders kind of miss the boat because they're reading the news headlines and they're factoring in these however many interest rates are expected, and you may still get the same number. Now, the extent of each of those might moderate slightly. That, there's sometimes murmurings of 0.75 point jumps. Well, maybe that only becomes a 0.5 point jump. And so all of a sudden you get the perception change. And the other thing with that markets being governed by perception is they also always overshoot. So the last few months, the perception has been this gross higher interest rate expectation. And so not only did the markets factor that in, but they overshot that like they always do. So even if the markets even if nothing else changed and the markets just came back to an equilibrium that's supported by the current fundamentals, they'd have to come back, whether that be bonds and notes rebounding a bit, stocks even rebounding a bit, and interest rate expectations moderating a little bit. Just to get back to that elusive equilibrium, they'd have to rebound. But often what you get is the perception changes slightly. So now that rebound is maybe double what it should be. And so you get this, the pendulum starts to swing back and things start to overshoot a little bit more in the opposite direction. So if we start to get talk of, I know there's a lot of focus on the inflation numbers coming out the end of this week. And if there's just a slight year over year or month over month moderation in those numbers, doesn't mean they've come down any, doesn't mean you're going to see lower prices at the grocery store or the gas pump. But the perception and the expectation and the extremity of that expectation has changed. And now the markets need to recalibrate that. And like I said, they don't just recalibrate it, they now recalibrate it to farther than they should.
Sure.
And that's what you get in the markets constantly. And I think that will be the case with interest rate expectations, that we could still see the same number of them that have been expected. The magnitude of them might come down a little bit. The time duration between the intervals between them might spread out a little bit more. So in the end, the interest rate factor might be the same, but all that perception in between changes, and that's what drives the markets.
Right. Yep. Gotcha. So it's expectations more than the actual reality. It's the perception sometimes overtaking reality.
Yeah, absolutely. And the markets are always, especially the stock market, but a lot of the markets, they're always discounting things 3 to 6 months out. So if you're hearing news now, you can pretty much assume, unless it's something that's such a black swan thing out of left field, otherwise, it's already been factored into the current market price, and traders are already starting to factor in expectations for 3 months from now, sometimes 6 months from now. So when a novice trader comes in and hears something on the news and says, oh, I should do this in the markets because this just happened, they're already 3 months late on that.
Right. So it's always looking at the charts is more important than looking at the news, because we all know how news is made. They used to talk about making legislation in Washington, D.C., where they get what they want and then the sausage gets made. I think, News is really substandard sausage.
Well, and you know what? I have often made the analogy to a doctor and the numerous tests that a doctor is able to run. And you could have, if someone had let's say a cancer in its early forms, you could wait until all of a sudden there are symptoms bursting forth on the surface, on the skin, on, in other factors. That would be like fundamentals, that when you finally see them, they've already been going on for quite some time. And in this case, the body has factored them in. But a doctor is able to take charts, take tests, And, he might see white blood cell counts suddenly elevated, and knowing that those white blood cell counts are often fighting some sort of infection or sometimes cancer cells. And so before there's any outward symptoms, there's already indications of something going on beneath the surface. Same thing with, heart and circulatory and things like EKGs and EEGs. Does anyone say that when the doctor looks at the printout of the tests that have just been done, do they say to the doctor, oh, that's just scribbly lines on a paper? That can't tell you anything. And that's the same thing with technicals on a chart. When your antagonists say, oh, they're just lines on a chart, that they can't tell you anything. It's just the opposite. You have to understand what those lines are reflecting, just like a doctor needs to know what those EEGs, EKGs, and the readouts of them are reflecting, what's normal, what's an anomaly, what's something of higher concern, what's a trend that projects a continued trend in the future, unless something comes along to an equal or greater force comes to offset that trend. And so it's a very similar, in my opinion, comparison between reading things like that show underlying causes and conditions that are developing, if you know what to look for, just like technicals in the market and the charts, that they start to reveal what some of the smart money is doing, what somebody is usually in the know about certain factors and are starting to put their money or hedge their product or their, whatever it is they're needing to lock in prices. That's already happening, and it's reflected in the price action on a chart long before the news suddenly tells you, oh, we've just gotten this report now that measures the last 3 months of whatever, and it's higher than we expected. Well, for those 3 months, that whatever that factor is was already developing, and many people knew about it, but it's only when it bursts forth on the surface that then you get the Johnny-come-lately traders trying to take advantage of it, and they're too little too late.
Yeah, well, the news is always dealing with history, right? And,
exactly.
And the markets are dealing with the future. So interesting thing here. So I guess when we talk about commodities, we're talking about food. Natural gas has been on a tear at $9.50 now, with seemingly with no end in sight. We can look for peaks come September, October for them as well?
For some of those markets, natural gas has that had even more profound and significant cycles, bottoming back in early 2020 and then again in early 2021. And for 2 years, every month in my monthly newsletter, all I've said is natural gas is moving higher from a bottom 2 years ago, and it should extend that uptrend into 2022. I had a pair of buy signals generated two years ago and a year and a half ago, and I had just nothing has ever altered those signals. So it has just projected progressively higher prices in natural gas. And that could, the next really significant cycle high comes into play late in the year, in fourth quarter of this year. So that could stretch out a little beyond some of these other markets, even if the overall commodity price index peaks in September, October. There are some isolated commodities that could still see higher levels a little beyond that. And natural gas is certainly one of those. But I also look at price objectives, and the two major price objectives, upside price objectives for natural gas. The first one was at $8.50, and the second one, the ultimate one, was at $10.50 to $11.50. And so, like I said, we've been spiking above the 950 level, but it wouldn't surprise me to see a little bit of consolidation up near there before natural gas is ready for another significant uptrend.
Really? Interesting. So we got a lot more. It could go substantially higher before it eventually finds its level, right?
Yeah.
Huh. Okay. Makes you wonder what's going to come next, huh?
Well, and that's the thing is you've already got the shortage factored in there where Europe demand and looking for other suppliers is considered. But over the last couple of years, natural gas has had kind of bigger moves, bigger surges on excessive heat in the U.S., during some of the summer months than it has during really cold snaps during the winter. And so that could certainly be a factor, or it could be getting into the early part of winter, or it could be something like has happened in the last few months that's completely out of left field.
Yeah, and that was what I was going to ask you. As far as the Ukraine-Russian war, can you glean anything from the charts when that's going to conclude?
Not really, and even conclude is one of those elusive terms. It certainly sounds like, and this is not based on the charts, but sounds like it's something that's going to smolder and go on for months, maybe years, depending on the resolve of both sides. No, I really can't. I suppose you could say that if commodity inflation is looking to peak a little bit later this year, it would depend on the levels where we peak and what is projected from those peaks to the downside, whether the way those peaks are formed projects more of a corrective period for a few months or an all-out downtrend to follow. That might have some correlation to the Russia-Ukraine situation and resolution of it. But all in all, no, I don't see anything convincing enough to make that connection or make any speculation about when that would come to some sort of resolution.
All right. Well, I think we've gotten a lot of useful info from you, Eric. I really appreciate you coming on as always. And make sure you go over to INSIIDE Track Trading. That's INSIIDE tracktrading.com. Take a look at Eric's site, and Eric, we'll have you on again in a couple of months and see how all this is hashed out. In the meantime, if you have a question for Eric, shoot us an email, kl@kerrylutz.com. And of course, sign up for your free newsletter at financialsurvivalnetwork.com. Appreciate it, Eric. We'll talk to you soon.
All right. Thanks for having me back, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.